Today we're going to talk about the conceptual framework. We're going to start with the primary elements of financial statements, and that is in this section here. We have already covered the objective, which is to provide information about the reporting entity that is useful to equity investors, lenders, and other creditors in their decisions as capital providers. That's sort of the why of what financial accounting is about. And we're working our way up to the how and how we go about delivering this information. We have already talked about the qualitative characteristics, which are our values, what we consider to be important related to qualities of the information that we're providing. We have determined that relevance, capability of impacting a decision, and faithful representation, that is, the information says what it conveys, what it says it conveys, that sort of faithful representation, are the two main qualities that we want to see in financial information. Today we're going to talk about the key elements of financial statements. These are the building blocks of the financial statements, and there are 10 of them. And then we'll move on to assumptions, principles, and constraints. So, as you know, in the conceptual framework, we have 8 statements. Not all of them are still there, and I must confess I don't know all of the different 8. But I know, for example, number 8 replaces number 2, so we no longer have number 2, and I think there may be one other that's also been replaced. But together, those 8 statements of financial accounting concepts comprise what is known as the conceptual framework. Number 6 defines the elements of the financial statements, and those elements are listed here. They are revenues, expenses, gains, losses, assets, liabilities, equity, we're talking about owner's equity, investments by owners, distributions to owners, and comprehensive income. So in number 6 defines revenues as inflows of assets or settlements of liabilities that occurred during a particular accounting period. So these cover a period of time. And these come from what we're in business to do. We deliver products or provide services. That it's either the delivery or production of goods. And we'll get later on into, for example, if you're building a ship over 3 or 4 years it takes to produce that ship, we can recognize revenue along the way using something called the percentage of completion method. But as a general rule, we deliver the products, provide the services, and they either cause an inflow of assets or a reduction in liabilities, and therefore we recognize revenue. Expenses, on the other hand, are outflows of assets or incurrences of liabilities during a period of time, an accounting period, that are related to producing revenue. So they're necessary for delivery or production of goods or rendering of services. I think of them as, okay, so costs of goods and services. And for me, anyway, when I think of expenses, it's really got to be used up. Costs of goods and services used up to produce revenue. The key here is that the goal is to produce revenue. Not all expenses will produce revenue. We can have an advertising campaign that does not produce revenue. We can have expenditures on research and development that do not produce revenue. But the intention was there to produce revenue. Contrast that with dividends. Dividends we can spend all we want on dividends, but the more we spend on paying our owners doesn't produce any more revenue. So dividends are not expenses. Sure, they're outflows of assets or sometimes incurrences of liabilities like dividends payable, but they certainly are not with the intention of producing revenue, which is part of what we look for in an expense. Gains and losses. Gains are increases to equity that result from, here's the key, incidental transactions not associated with the company's major business. In class, I used the example of a pizza restaurant that has a delivery car, and they sell the delivery car. The delivery car is not what they're in business to sell. They sell that car, and the excess of the proceeds over the net book value, that is the cost minus accumulated depreciation, is a gain. And if the difference is negative, it's a loss. Contrast that with a car dealership. And the car dealership sells cars. If they sell the car and they sell it for more than expected, they're going to have a gross profit. That is revenues, sales revenues, minus cost of goods sold. And that's different. Those are revenues and expenses. Here, we just show gains and losses, and they're different from what we're in business to sell. Think about the pizza delivery car. That's not what we're in business to sell. We're in business to sell pizzas. Next, let's take a look at the balance sheet. Assets, business resources that have probable future economic benefits. These are typically come from some past transaction that causes that. So we have some sort of historical cost that shows up on our books because of some past transaction. There are a lot of business resources that could have probable future economic benefits. In class, I use the example of a ski area, and they get a whole bunch of snow. Well, that means a lot of skiers are going to come. But just because they got the snow, and the snow is not an asset that we put on the balance sheet. Yes, we are going to get skiers because we got the snow, but the snow itself is not an asset, at least when it comes naturally. You could argue it might be a little different if you produce the snow in the snow-making capacity. That's something different. But if a big storm does it, it's not an asset. Liabilities are probable future sacrifices of economic benefits, things that we owe. Liabilities, something owed. Equity, this is what's left for the owners. It's the assets minus the liabilities. It's what's left. It's known as the residual, meaning what's left, interest in the assets of a business entity. Sometimes we call it net assets. It really represents what the shareholders have invested in the company at a conceptual level. Literally, they've invested, they contributed capital. But conceptually, they've invested also the retained earnings because, at least conceptually, the shareholders could demand that the retained earnings get paid back as dividends. Instead, they decide to leave it in the company through the governance system that they have and let it ride, let their investment ride. So residual interest, or this equity, is really the amount that the shareholders have invested, the combination of contributed capital and retained earnings that's left, profits that have been left in the firm. Statement number 6 also talks about investments by owners. These are increases to equity resulting from capital contributions, an asset contribution by owners. And just the opposite is decreases to equity resulting from distributions to owners. These are typically dividends or treasury stock repurchases. And then the last item that we need to talk about is one that you probably have not seen before, and it's called comprehensive income. This is the change in equity resulting from all of the transactions that during a particular accounting period, except transactions with shareholders. Transactions with shareholders, either investments by shareholders or distributions to shareholders, are excluded. The thing that we're going to talk about here is, so far we've included revenues and expenses, gains and losses. But there's another thing called other comprehensive income that is included in comprehensive income. It's the other stuff, and generally it's two things. The change in market value of marketable securities. So we have some stock in another company we hold as an investment. Say we bought some Google stock, we paid $50,000 for it, it's now worth $125,000. GAAP requires that we report at market value $125,000. That is, the assets increase from 50 to 125, and the shareholders' equity also increases by that 75 above the historical cost. That increase is called other comprehensive income. It is not in revenues, it's not in expenses, it's not in gains and losses because we haven't realized it. We just own that Google stock. We paid 50 for it, and it's now worth 125. This is called unrealized income. We also have it with foreign currencies, foreign currency translation gains and losses, for when we've got assets that have increased or decreased in foreign currencies, but we haven't brought them back to the home currency. In the United States, that would be the US dollar. Okay, so that's comprehensive income. Let's take a look. This is sort of a walkthrough, some of the elements. We're talking about the second level. The first level was the objective of financial reporting. Then we moved up and we talked about the qualitative characteristics, relevance, representational faithfulness, and the components of those. Now we're talking about the elements. Let's take a look at each one of these just to kind of walk through quiz. Identify the element or elements associated with the items below. A says arises from peripheral or incidental transactions. Well, that was two things. That's our gains and losses. They are peripheral, like the sale of the pizza delivery car for the pizza restaurant. B says obligation to transfer resources arising from a past transaction. Well, obligation, what does that sound like? Liabilities. B would be liabilities. C says increases ownership interest. What of these elements causes increases to ownership interest? And I would say the investments by owners, comprehensive income. Remember, comprehensive income includes all of these: revenues, expenses, gains and losses, and other comprehensive income, the change in market value of marketable securities and foreign currencies. But revenues also increase ownership interest, and gains also increase ownership interest. So investments, comprehensive income, revenues, and gains all fit in this C category. D says declares and pays cash dividends to owners. Well, that would be our distribution to owners. E is increases in net assets in a period from non-owner sources. So this is everything that increases shareholders' equity, because remember, net assets and shareholders' equity, they're pretty much the same thing. We consider them the same thing. Well, from non-owner sources, that would be everything down here that has a positive effect on shareholders' equity. Comprehensive income, revenues, and gains. You would not, however, include investment by owners because it is from non-owner sources. That would not include that. F says items characterized by future economic benefit. That's assets. That's assets. Things that we own that are going to give us a future benefit. G equals increase in net assets during the year after adding distributions to owners and subtracting investments by owners. Well, equals is a very specific thing. It's not a catch-all, and it's the increase in owners' equity not from transactions with shareholders. So that would be our comprehensive income, G, comprehensive income. H arises from income statement activities that constitute the entity's ongoing major or central operations. I would say our revenues and our expenses. That's what we're in business to do. Produce revenues, causing expenses. All of those things are major operations of the business. I, residual interest in the net assets of the enterprise. Well, that's our owner's equity, or just equity. That's our equity. J, increases in assets through the sale of product. Well, that's what we're in business to do. That's going to be our revenue. The price of goods sold or services rendered, revenue. K says decreases in assets by purchasing the company's own stock. So we're going out there buying our shares from our stockholders, thereby giving our stockholders money. It's a distribution to owners. Purchase of treasury stock is what we call that. L says changes in equity during the period, except those from investments by owners and distributions to owners. Okay. Well, the main thing, the best answer for that is comprehensive income. It equals the changes in equity during the period, except those from investments by owners and distributions to owners. However, all of these things, revenues, expenses, gains, and losses, each one of them is a subcomponent of comprehensive income that changes equity. So I'd say, yeah, you probably ought to also include these things in that. Okay, so there you have the elements of the financial statements.